Welcome back. Today we're going to talk about a couple of things that are probably a little bit more on the academic side, like household debt service ratio and debt to GDP, but I think it really does help frame our current economic condition and what we can expect from markets. The household debt service ratio, the DSR, it's a ratio of the total required household debt payments to disposable income. Essentially, it measures consumer loans, mortgages as a share of GDP, gross domestic product, how much we're committed to in terms of loans. The financial soundness indicator of households essentially measures the debt service and principal payments as a percentage of our income. How much of our income are we committed to debt service payments, loan payments, things of that nature? And then finally, the debt to GDP ratio, which is a metric that we all know that measures essentially the level of debt to gross domestic product within a country, and we use this to compare different countries to each other. First off, the household debt service payments as a percentage of disposable income, which again is how much we are committed to paying in terms of loans, compare that to the personal income. This is shown in purple. The higher the line, the higher our debt service payments are. Compare that to the red line, which is the S&P 500. Now, we look back to 2016 through 2019, even 2020, we're at a very significant level 9.75, 10 in that area. S&P 500 was, chugging higher. Obviously, we all know what happened with the 2020 COVID crash in the stock market, and the debt service payments were very much reduced. But I think this is a little bit distorted as a result. First of all, a temporary halt in the economy, but also loan forgiveness programs, things of that nature. What's interesting, though, is that it stayed relatively low through 2021, only started to climb back recently. And notice that we're almost at pre-pandemic levels, currently at a 9.7. If we see this line moving higher, especially approaching the 10 level, that would indicate that our debt levels have returned to pre-pandemic levels. This is the household debt to GDP for the US compared to the S&P 500. Now, stocks tend to move higher, and our household debt to GDP also rises. Again, this was very much chopped down during the pandemic, and it stays actually, relatively speaking, on the lower end. But certainly with higher interest rates, which, by the way, we're going to talk about, this could certainly rise as well. The debt to GDP versus federal funds. Federal funds are in green. Notice the debt to GDP level really rose during a period of low interest rates. First off, in 2016, our debt to GDP ratio was up near the 80 level. When interest rates started to rise, our debt to GDP level started to decline. Maybe that's just because higher interest rates act as something that would push us away or dissuade us from taking out loans. The higher interest rates make loans very much unattractive. But then again, we have low interest rates all over again. 2020, debt to GDP ratio skyrockets. As interest rates continue to rise, the debt to GDP level reduces or goes down. Now, the fact of the matter is, I think this is not necessarily a good thing. Obviously we want to see a lower household debt to GDP ratio to be certain. That shows us that the economy is in a healthy state. But when that happens as a result of higher interest rates, that's more of a phenomenon we can observe. That's not necessarily a sign of good economics, so to speak. We want to see the debt to GDP ratio go down despite the movement of interest rates. Here we see the debt to GDP ratio in purple versus the 1-year bond in green, 10-year bond yield in the 10-year bond yield in red. Now, notice again, we know during a period of low interest rates, we tend to see a higher debt to GDP ratio. Now, in particular, and the reason why I want to kind of show this against the bond market, notice the behavior of the bond market. We have the red line, the 10-year treasury, much higher than the green line, the 1-year Treasury. This is a healthy economic condition because this shows us that our long-term outlook, the 10-year Treasury, is much higher. There's a greater spread between that and the 1-year that shows us that long-term optimism is even better than short-term optimism. Now, when we start to see the markets turn and we see 2019, the 10-year bond decline and actually cross below the 1-year, the beginning of the inverted bond market. Well, it flirted with an inverted bond market condition. That's when the household debt to GDP ratio declined. But then again, that's not necessarily the result of a proper economics because, again, we'd want to see these bond yields rise. Ideally, in an ideal situation, we'd want to see the bond yields rise. We'd want to see the red line, the 10-year Treasury, move away from the green line, the 1-year Treasury. At the same time, household debt to GDP declines as well. Fast forward to more recent times, we see here the yields are skyrocketing. Now, we know this is a result of higher interest rates, and we know it's an unhealthy bond market condition as the 1-year, the green line, soars above the red line, the 10-year Treasury, creating the beginning of our inverted yield curve that we know of today. That occurred, second, third quarter of last year. Now, during that period of time, household debt to GDP declines. But again, that's not the result of proper economics. That's the result of higher interest rates really dissuading any type of investment or loans, mortgages of that nature. Now, the financial soundness indicator, and just to refresh your memory, financial soundness indicator measures the debt service and principal payments as a percentage of personal incomes. So we think of our own personal income. How much of that personal income is spoken for as a result of debt payments, car payments, mortgage payments, things of that level? How much of our income is committed to those type of payments? When the line is higher, it means that we have more financial soundness. When the line goes down, it certainly means that we have more commitments. And the S&P 500 goes up under a climate of greater financial soundness when this goes down. Interesting enough, our debt to GDP, or not debt to GDP, but rather our financial soundness indicator is rising, has been rising, and is nearly at the pre-pandemic highs we saw in 2017, 2018. This shows us that our debt payments represent a pretty significant part of our overall disposable income. Not really a good thing. We take a look at the financial soundness indicator versus the 1 and 10-year bond. The 1-year bond yields in green, 10 in red. Now, we see that as this remained quite high, we see the bond yields rise. But then again, when the bond yields start to fall, and there's a pretty strong correlation. Now, we see the bond yields move first. This seems to have a lagging indicator type of effect. We see the bond yields start to decline as well. More recently, inverted bond, and very interesting, the inverted bond, we'll take a look at a couple different things. First of all, interest rates and bond yields are higher now than they were in 2018. That could be the result of two different things. It could be the result of a strong economy, where the bond market's saying, hey, we got to raise interest rates. We have to offer higher interest rates to compete with a very strong stock market. Or it could be the result of high interest rates and poor economic conditions like we see right now, where the Federal Reserve is battling inflation, but it's doing that despite not very strong economic conditions. Well, very interesting that the interest rates are higher now, but only higher under an inverted bond yield condition, which we know is not typically something we see under good conditions. Inverted bond yields tend to precede troubling times or coincide with troubling times economically. This is a very steep inverted bond yield, of course, as well. So the financial soundness indicator is near its highs, but so is an inverted bond yield. But then again, we know that the financial soundness indicator has a lagging effect. It moves down only after the bond market has really gone down. So, question. Will this financial soundness indicator begin to decline in light of a very inverted bond yield curve? I would venture a guess, probably so. Now, speaking of the bond market, we see this is today's change in treasuries. The 1 month T-bill on the left-hand side down 8 basis points. The 2 month up 8 basis points. Almost unchanged. The bond market has been very quiet. The stock market was higher today, but I think that's more in anticipation of maybe resolution and debt ceiling crisis. Nothing really on the economic front, I think, that is moving markets to a great extent. These are where U.S. current treasuries usually currently sit. The 1 month T-bond is at a 5.5% interest rate, the 2 month at a 5.06%. And all the way through the 1 year, we see much higher interest rates than we see on the 5, 7, 10 year. Very much an inverted bond market is here for the time being. 1 month change in treasuries. The biggest move over the past month in bonds has been the 1 month T-bill, skyrocketing after we know our last jobs numbers, and then after that, or just prior to that, the Federal Reserve meeting. 1 month change in bonds. We see here graphically the dotted black line at the top represents the 1 month T-bond, which again experienced a tremendous move to the upside. And we're going to see what that means over the long term in just a second. And that's very much higher than the solid red line at a 4 month, the dotted yellow line, which is the 3 year. All the other bonds are much, much lower, and especially the longer term bonds like the dotted red line at the bottom, that's the 10 year. That really demonstrates how much of an inversion we see. Speaking of inverted bond markets, I saw over a 133 basis point spread this afternoon on the 10-1 bond. 10 year is in blue, 1 year bond is in red. Notice how this is ever more widening. The inversion is demonstrated by these downward pointing histogram bars, and it really goes to show an important concept that we're at a greater point of inversion on the bond market than we've been since the beginning. And what's very interesting here, black line 1 month T-bond, red line is the 1 year, and the purple line is the 10 year. The histogram bars in the background of the S&P 500, and this is, I think, the takeaway from all this. When we saw the 1 month T-bill decline, that was in anticipation that maybe the Federal Reserve was at the end of its tightening cycle. 1 month T-bond declines. We saw a relatively tight range, relatively speaking, between the 1 year and 10 year bonds. But notice what happened. All of a sudden, we had a slew of economic numbers, jobs numbers, Federal Reserve meeting, and many others. And as a result of all those numbers collectively, the net result to the market, the 1 month T-bill skyrocketed. That occurred as the bond market basically said, I don't think that this is the end of interest rate tightening. Maybe we're going to see the Federal Reserve raise interest rates another quarter point in the next meeting. We're not at the end yet. We have not ended yet. Now, as a one month bond, 1 month T-bill goes, oftentimes the 1 year will follow. Well, that's what's happening now. The red line is pointing up. We're at a 4.88 yield on the 1 year. When was the last time we had a 4.88 yield? Well, it was a 4.86 May 1st. We have to go back all the way to March 13th for a 4.3 yield, and then before that, March 10th for a 4.9 yield. We have not seen, in probably 2 months now, these high yields on the 1 year. So the 1 month T-bond seems to be leading the 1 year higher, but notice what's not going up. The 10 year. The 10 year's at a 3.57. The 10 year has not been able to break above a 3.60 in quite a long time. In fact, the last time we saw the 10 year above 3.60 was going all the way back 2 months ago. So in that period of time, let's say they take 2 months ago, the 1 year has gone from a 4.19 to a 4.88, 69 basis points. The 10 year in the past 2 months has gone from 3.64 to 3.57, down 7 basis points. And that shows us how much wider the spread is. Why is the spread important? Because the spread demonstrates the market's opinion about the current situation and the long-term situation economically. Current situation we see reflected with the short-term maturities like the 1 year. Long-term economic conditions better demonstrated by the long-term interest rates. So as a result, we see a greater disparity between what we expect now and what we expect long-term. And that is not good, I think, over the long term for stocks, because stocks move in anticipation of higher or lower corporate earnings. And how great can we expect corporate earnings to be if the bond market's telling us that the economy is on shaky footing, to be sure. So we have a slew of economic numbers coming up, and we're going to watch the bond market behavior very closely. But I think it's important to just watch the market behave as it reacts to the economic calendar, and also take into consideration these larger macroeconomic concepts like debt to GDP ratio to further, be able to frame the economy in ways we can understand. We hope this has been helpful. We look forward to seeing you back soon.